everyone to today's webinar. So I guess a little bit about my background. So I completed my PhD at the University of Durham in real estate finance. And then, as Sonia mentioned, I'm a teaching associate at the Department of Land Economy at Cambridge and a principal lecturer at Wrexham University, where I oversee our postgrad and undergrad programs. So today I'm going to be talking about residential real estate, and I speak from both an academic side and an actual investor side. So I've got a business with the fifth largest buy-to-let company in St Helens, where I live, and so I do both. And so I even had the nicety of solving a break-in yesterday. The woes of being a landlord, so to say. And this is part of it, though, is we learn both the academic and practical side with real estate. And people sometimes forget that real estate is a real good. You can actually go and touch it and physically handle it and change it. And we'll touch on some of that a little bit later on the valuation methods. So as Sonia noted, we'll talk first about some of the basic characteristics. We'll go into how you can, the ownership structure and how that can affect your returns potentially. We'll talk about the main valuation methods and then talk about some of the trends, because obviously since the general election, which happened very recently, that's going to affect real estate in the valuation side. So we may not see it right now, but with the policies that may be enacted, and remember, this is a politically neutral conversation. It's more of how policy can potentially affect our valuations today. So let's jump into it. I'm just going to see if I click there. Perfect. So when we talk about residential real estate, these on the left-hand side are the main kind of categories that we may want to invest in. So we're not talking about commercial real estate, which is offices and retail and maybe warehouses, what have you. We're talking about the things that we live in. And so this is often maybe single family homes, detached, maybe semi-detached. A common buy-to-let vehicle in residential investing is through a terraced house across the country. Apartments/condos can also be done, and you'll often see them investments in the built-up areas, so the central business districts near city centres. In America, if you care about American real estate, they'll often call them condos. And then sometimes mobile homes, or what we call static, say lodges that you might see up in Cumbria in the UK, where you can invest as a holiday let, and there's different mortgage deals that you end up having to do with them. And each one of these buildings have their own characteristics that you have to think about. It could be the area, it could be the type of building, it could be the leases, which is a very important thing that keeps coming on the news. Probably every 6 months or so, is about how leaseholders are very concerned that after a certain number of years, they're going to give back their lease, and that they're getting charged quite high rates. And so the leasehold issue is a recurring one that there's no quick fix. Someone will have to take the fall for that at some point, but we can maybe touch on that in the Q&A later on. So these are the main areas of residential real estate and kind of what you can invest in or what you may live in yourself. If you don't live in one of them, I'm intrigued, please let us know in the comments. But I imagine most of us live in one of them types of residential property. And it's actually a really big area of investment. Commercial real estate has more investment in, partly because of the high valuations that are associated with them and the locations of commercial real estate. But housing is often the second or third most valuable asset class to go and invest in. And in particular, we saw over that COVID-19 pandemic, it was one of the best performing real estate classes throughout that pandemic. And this is why we're seeing a lot of investment firms moving and changing their real estate allocations into residential real estate. And if we think about that, that's because no matter what happens, we all have to live in a home. And the policies that were enacted over the COVID-19 pandemic didn't really affect residential investments. And so when people can go into the office, obviously people start to default. Some people ask for rent reductions, where in residential real estate, obviously people are now working from home more. There's more demand, and with high population numbers, that demand is also going up. And the lag, we call it, in building of residential real estate, i.e. even if a policy is enacted today, it will take multiple years for that to come online. That means that the supply is constricted over the short and medium term. Long term, of course, though, we can expect more houses to be built depending on the policies. So in terms of a valuation metric, it's a very important asset class, and a lot more people have eyes on residential real estate compared to commercial asset classes. And if we go back to basics on figure 2, we can look at what our components of a return are. And these are long term. And every investor will have a different kind of return ask when we look at this component here in the bottom right. And so even though I'm giving general numbers, my own numbers that I would invest in may change compared to yourself, compared to someone investing, say, in London residential real estate. So let's look at each component individually. And the first one is the liquidity risk premium. And that comes from the idea that if you buy a residential property, it's going to take time to get that money out if you're trying to sell to close out an investment, or if you need to sell to have that money. Maybe there's a liquidity risk, maybe you need cash. And in regular circumstances, a residential property you can sell in maybe 3 months on average. It varies on solicitor times and what mortgage documents you may need. On the very quick end, if you sell a property maybe at an auction house, which I've done before, or buying through an auction, you can complete an average in about 1 month. 28 days is the normal working time. You can do it in a week. Is some of the quickest I've seen. If you don't do any of the checks, really, you just do the very, very basics. But really, the quickest you're going to get your money out of real estate is a month on average, say. Generally speaking, on an orderly sale, it's going to take 3 months to get that highest valuation. Obviously, in commercial real estate, that's often taking years to get that sale through. So this is why we have a liquidity risk premium. You don't have that in other asset classes, say with stocks and shares or equities. You can sell them on the stock market today. The markets are open. You can get your cash out instantly. If you've got a large stock holding, it might take a couple of weeks to sell it in an orderly fashion. So because of this lack of kind of liquidity, how long it takes us to get our money out, we expect a premium for that risk that we bear. The next would be the property risk premium, and this is the idiosyncratic risk found within each building. Every building that I go and buy has something unique towards it. And, we don't have homogeneity in real estate. Everything's different. And so buildings aren't built the same. There's always slightly different room sizes, angles, where it's facing, sunlight, if it's a south-facing garden or not. And so every property has its own individual risk. And so depending on the allocation you apply to that risk, it's generally between 2 and 3%. And so you've got to look at the individual risk within that property, and we call that the premium. And it's often the hardest one to come up with a figure for, and is really individual. The next component is our real rate of return, and that's our return above the risk-free rate and including inflation. So to give you an example, the current risk-free rate that we might proxy from treasury bonds or treasury bills is around 5% at the moment. And so we need to earn at least a 5% return, because otherwise you just invest in them risk-free returns, and you should get that return with no risk whatsoever. There's no need to invest in real estate because you're going to get that guaranteed from the government. So you need to earn your risk-free rate. You then also need to earn an inflation premium, because as inflation has been really high over the last few years, your real return could potentially be negative. So we have to also account for this real return component. And that turns into the last part, which is our inflation premium, which is about 2%. Remember, if our overall return is below the inflation rate, you actually have a negative return on that property, i.e. you're losing money year on year. If you look at some of the academic studies, a good one is Professor Thies Lindenthal, who actually works at the Department of Land Economy. In his paper, he always notes that actually the returns in real estate, especially residential, is over a long time period is driven from rental income and not the capital values, i.e. buying to hold over a long term and the property goes up in value. Obviously, this is kind of goes against what a lot of people think. And that's because of the bias that we have over the last maybe 10, 20 years, where even before the financial crisis in 2007, real estate prices have gone up significantly. But if you look back in time, they actually on average didn't go up by much, about 0.25% a year, where on a rental value basis, it goes up on average 6% a year over a long time period. So if you combine these components together, I know some of the numbers here will change, and this is a general view with stable markets is what I'm presenting here today, is you add these up and this should be your minimum required return for investing in real estate. And if you don't achieve that, then you are unnecessarily taking risk investing in residential real estate. And there's ways to calculate each one of these components. It can get quite complex, though. So that's kind of the overview of residential real estate and the main return that we should be thinking on an academic basis. Let's look at the ownership structure now of real estate. And the most common form that most people do when they come to buy their own home or even a buy-to-let is through their own name. You can buy a property and you'll buy it in Robert Leigh, my name. And that's the most common form of ownership of residential real estate. And it's highly tax efficient to do this if it's your primary residence. So if you're buying your first home, you should buy it in your name. Most likely, I should caveat, we're not giving financial advice today, so you need to speak to an advisor, an accountant on that. But generally speaking, it's quite tax efficient because we've got Help to Buy, ISAs that the government supports. You've also we've had stamp duty cuts, and some of the policies that the new government is bringing in is trying to support first-time buyers. And so we find that it can be very tax efficient if you're living in that home. However, rental income is going to be taxed as additional income. So if you have a job and you've got buy-to-lets and you've got rental income, it could quite easily push you into the 20 or 40% tax brackets. And this is one of the big issues, is actually, you get taxed at your personal income tax rate. And that can be quite problematic because personal income tax is very high compared to company tax rates, which we'll discuss in a minute. And the other bit is that you cannot claim back the interest payments. You can, for a certain percentage, I believe 20% of the total interest payments, but actually it's more tax efficient through a company. And so if you're setting up a large buy-to-let business, you don't set it up in your individual name, or generally speaking, it's not advisable, unless your tax status is maybe in, say, Monaco, where there's zero income tax. But if you're living in the UK, I wouldn't be doing that myself. So let's look at the second most common company structure or ownership structure that we have, and that's through limited companies. And so this is, like I said, the second most common, and this is what we're seeing more and more larger investors doing, and that's how I invest in residential real estate through limited companies. And the reason we do that is partly because of its limited liability. So if anything goes wrong, it's not going to come back on yourself. The other part is you get the tax deductibility on that interest. Again, we used to have that when real estate was owned in your own name, but the government took that away from landlords maybe about 5-10 years ago now. And again, making it less efficient. So what we're seeing is larger investors are going towards limited companies. Remember, though, there's higher accounting costs and meeting the limited company statements that you need to file yearly, much more complicated than personal income tax reporting to the HMRC. And also you can, in theory, set up multiple limited companies and just put one property in each one if you wanted to. And then if anything happens, the legal liability is just to that one company alone. So remember that limited liability has a lot of power in saving yourself if anything did go wrong. But that's just an opinion. It's up to you to make a decision on that. Remember, these can be structured offshore, and so the large investment firms who are investing in residential real estate will do that. Not notable places are maybe the Cayman Islands, or not Guernsey, but Isle of Man, I believe, has good tax statuses for companies. Ireland is another good one. Low corporation taxes, and so that can be another benefit for setting up the company somewhere else. The other thing to note, remember with a limited company in the UK, you're paying 19% corporation tax. It is going up soon, but remember, personal income tax is anywhere between 20 and up to 45%. And so, of course, if you're paying 19% tax on profit, over multiple years, you're going to be able to generate significantly more money. The hard bit with the company, of course, is how do you get that money out of the company and into your own name? And this is where dividends and what have you come into play. And there's a lot of financial management of how to do that effectively. Finally, to note with company structures, we've got REITs, so real estate investment trusts, and REOCs, real estate operating companies. REITs and REOCs are generally for investing in, say, residential real estate, but you're talking of maybe £100 million of investments or higher. REITs need to distribute approximately 90% of their income to their shareholders, and they need at least 100 shareholders. So the idea is that they're tax efficient, these real estate investment trusts, primarily based in the US, but they need to distribute their money to the shareholders, and they get very low tax treatments. However, it means growing the REIT can be difficult and often requires directors' investment in to grow that significantly. REOCs, on the other hand, do not have the tax, the special treatment on the tax. However, they've got much more flexibility and often take higher risks when investing into residential real estate. This might be building new residential real estate. It might be the change of use from commercial to residential. REITs, on the other hand, are generally looking at stable investments. We buy a large portfolio of buy-to-let, and it's already stabilized with a return of, say, 6%. REOCs are generally looking for more risk, higher reward, and we'll touch on that probably a little bit later on with different webinars. The final route, which used to be a favoured way, but can be quite complicated, is through trust structures. There's a variety of trusts that you can take out, and actually this used to be tax advantage because it was independent of when you die, so you didn't have to pay inheritance tax, which is one of the biggest issues. If you've got a large real estate portfolio, how do I pass that money on to my children? And so trust structures were often used to bypass this. If people got married and divorced and all them complexities with regular life, the trust would continue on. And so it was very good for asset protection, and often it's a very secretive way if you don't want your name to be attached to certain buildings, i.e. governments, large corporations who want to have anonymity in their ownership structure of residential real estate. It's a good way for them to own, and that's what we often see in London. Often you'll find high net wealth individuals still utilize trusts today. And again, these can be made offshore. Remember, with all residential real estate in the UK at the moment, you have to report who owns it. There's more laws coming into place that if it's owned in trusts, there needs to be more information given on who is the direct beneficiary of that residential real estate. So this trust structure is becoming weakened over time, year on year. So company structure at the moment is probably the most favourable. If it's your own home, buy it in your own name, is my piece of advice for you there. So let's have a look at the valuation side, and I'll start in the top right because this is probably the most common way that people come about valuing their own property or valuing a piece of investment that they might want to do, and that's using the sales comparison approach. And so often what we will do is look at past trends, either in sale prices of comparable properties, or maybe looking at comparable listings if it's a rental property, to identify what's the market price for my piece of real estate. There's a variety of comparable features that we may want to use, and so I've noted some on the slides there. Bedrooms and bathrooms are often a common one. I might be buying a 3-bed property, but my comparable's a 4-bed. How many bathrooms does it have? Location is another one, and floor space. But when you do this on a proper investment basis, you go into much more detail. You might want to look at the distance to amenities. So it could be, for example, the distance to transport links, to the central business district if you're investing in a city centre. More commonly now, we're seeing EPC is a big indicator for investments. So obviously for residential real estate, that needs to be E rated. The new government, I believe, wants to make that a C. So obviously that can be an important factor if you're going to hold that property over a long period of time. The other things that might come into account might be the age of the building, i.e. how much depreciation and how much renovation you might need to do and repairs in the future. What way is it facing? What is the kind of the damage to the property? So you could come up with indicators as well there. And what you will do with a comparison approach is you will look at your target building and you will look at the comparable. You will then look at the features and note that your comparable building, what does it have, which is better? What does it have if it's worse? Then the difficult bit to do this properly is to come up with an estimate of the valuation of each one of the differences that it may have. So you may want to come up with £40,000 is the value of one additional bedroom. So if I'm buying a 2-bed and I'm comparing it to a 3-bed, I need to deduct £40,000 off to get to my comparable amount. The hard bit is maybe have I overestimated that 40 or underestimated it, and there's no true way of doing it. There is guidelines on how you can do it, but it's quite difficult to do. On a very broad basis, people generally just look, oh, well, it's slightly worse and it's slightly better. But to do this properly, you should have a big table and compare against all features. And that would make a much better comparison approach. So be careful if you speak to your parents or friends, if they don't know much about residential real estate, they often kind of make it very simple, the comparison approach. It is more complicated to do it properly. The next one that is rarely used, and go to the bottom right here, is our cost approach. And this is an approach when we're thinking of, do we need to change the building? And so there's a method that we go about it. And my advice is you're probably least going to use this approach with residential. It's more of a commercial valuation method. The cost approach is where we estimate the land value. We're going to look at the replacement cost of the building. And so how much does it cost to replace? It might be done on a square footage or every square meter. Come up with a value per square meter and times that by the total area. We deduct any depreciation that we believe, and we add that land value back, and you get the market value of the building. Again, cost approaches aren't used often for maybe development projects or larger investments. But if you're looking at a smaller scale, I'd be much rather use comparison or the income approach. Just be aware with the cost approach, there's two main methods that people will utilize. We've got the reproduction method and replacement method. And so when we're looking at the reproduction method, this is where you're going to maybe repair it or change it or rebuild it, but with the same materials and often the same techniques that was used to build it. With a replacement, we're looking at utilizing the most current construction methods to do that. So if we're renovating because it's maybe a listed building, you might want to use the reproduction method. They'll probably force you to use that method. Where if you're building new or knocking something down, it's going to be the replacement method that you use. If we move to the top left now, I've done this in an odd order, but that's how I roll. We'll go with the income approach. And this one is a very good ballpark figure. We take our net operating income in period 1, so we can estimate that over the next year, and divide it by the current market value of the asset. And so that might be the price that the listing it at, the price that you believe that you're going to be able to buy it for. And when you divide them, you're going to get your capitalization rate on the building. And hopefully, one thing we should be aware of is, what does the cap rate tell us? So if we have high cap rates, that's indicating that we're getting a high return per unit of the building, so a high return. We often associate high cap rates with higher risk. So some common features with cap rates, you may think higher cap rates would be buildings in more sparse areas, so not in the CBD, therefore the market value might be lower. It might be that it needs significant renovation. It might be that there's issues with it. So I often view it, cap rate is indicative of risk. And so if you see high cap rate buildings, there's generally a reason why, and I want to know why that is. So as you go closer and closer to a CBD, you're going to see lower cap rates. So remember, how do we change our cap rate? We need to either get the market value of the asset lower, or can we potentially boost our net operating income by doing rent reviews with our tenants and increase that to a high level? And then again, that will boost the cap rate. And that cap rate will inform when you come to sell a building, obviously just rearrange that equation, NOI over cap rate, and that will give you the value that you potentially may get when you come to sell. So food for thought there with the income approach. The final approach, again, lower value approach here, is the gross rent multiplier. And that's taking our sales price divided by our annual rent, i.e. how quickly does it take me to earn my money back? So if I've got a high sales price and a low annual rent, it's going to take me a long period of time to earn my money back. Therefore, you have a high gross rent multiplier. So we want to see that as low as you can on the investment side. Okay, so finally, just some kind of comments about the current trends in residential real estate. If we have a look at some of the concerns, what we're seeing is that obviously people are going into work less, on average, maybe 3 days a week now working from home, like I am myself today. And so with this change in working pattern, we're seeing increased demand in residential real estate and actually a change in the dynamics where people are looking and putting still more weight on larger buildings, selling more at a premium, and also the area. People want quick access to work still, because they're aware people are asking them to still come into work, but they want that benefit of living in often a more rural place or having a higher quality of life. And that's something that we're seeing. So them properties a bit further away with them characteristics is selling at premium still. We have a lot of political instability. This has been the case for quite some time, and with a new government that we've just elected, we're going to see even probably more instability in terms of policies. We know with the new government they're looking to build many houses. The issue we have with this instability is investors in real estate are generally looking at minimum 5 to 7 year holding periods, often longer, and therefore you want political stability in terms of landlord approaches, say for example with the Renters Reform Act that is still currently being debated and might be brought back, which would abolish Section 21. So that's something that causes issues with multiple landlords, and also with first-time buyers, with changes in house building practices and potentially on worse land, which we call brown sites, and ugly areas of land, to quote the Labour Party here. That again can cause dynamics in the house prices. So we want stability with real estate, and that's where we get long-term investment from. We still have housing affordability issues, and this touches quite nicely on next week's webinar where we talk about affordable housing practices and the investment side on that. Of course, with increased housing affordability issues, we may see more government intervention, potentially the supporting first-time buyers. Potentially, we may see rent caps put on, like we've seen in Scotland over the last 5 years. Again, the way to view a lot of this intervention is the more you intervene in a residential market or any real estate market, the more policies you enact. Generally speaking, like anything, you will end up seeing the cost of that going up. So the cost of compliance, which will be passed on in the rents, which mean rents will go up, and also the property prices will accordingly. So we have to be very careful of how we enact policies because they can have quite big implications. And that's why we've seen in Scotland rent going up by 11% per year compared to the UK average of about 6 or 7%. Again, because of some of the strict rent controls they put in. Also, we're seeing tax rate increases and quite a large, that's part of this stamp duty that they put on investment properties. And that's something that we need to be aware of. The final, some other things just I wanted to quickly note. ESG, as I noted before, is becoming increasingly more important. So are the high efficiency, and also what's the ESG kind of rules that these big companies have with residential? Are they kicking out tenants? How are they increasing rents? Is it sustainable? And is it fair for everyone? We're seeing more migration, as I said before, to the suburbs. Inflation has gone down slightly, but will we see that it goes to a new norm at maybe 3 or 4% instead of our Bank of England and Federal Reserve's target rate of 2%? Higher inflation, as you saw before, increases the returns that we need to achieve on our rental buildings. Default rates have already started to go up, and a quirky thing going on in the market at the moment is tenants are asking for landlords to give them Section 21s so they can actually go into council houses, because they need to be in the process of being evicted before they're able to be eligible for that, because of the high rents in the private market at the moment. So that's an interesting one, which most people think it's the landlord trying to sell up. We're actually seeing a change in that at the moment now. Again, Section 21s might be abolished soon. And rental yields are set to go lower in the future, especially if there's more government intervention. So